Problem 3 in Connect, this is exercise 9.3 in your book, talks about an oyster company, I'm not even going to try to say that name, that farms and sells oysters in the Pacific Northwest, and they want us to compare the flexible budget numbers with the actual budget numbers. So they told us that their flexible budget, they called for 8,000 pounds of oysters to be harvested, which is really weird because you don't harvest oysters by the pound, you harvest them by the quart or by the bushel. But we'll pretend they know what they're talking about. So they harvested and sold 8,000 pounds. And the flexible budget called for 8,000 pounds. So they hit their mark with regard to oysters harvested and sold. These were the flexible budget numbers for those, and they give us the formulas right here. And you can work out this formula yourself if you like. Add up the total fixed cost and add up the total variable cost. And then multiply the variable cost by 8,000, add it to the fixed cost, and that's your total cost. And then they tell us that the total income was $11,420. Now the question is, how do we do? That's what we expected to do. All of these numbers here were expected numbers. This is the flexible budget. Okay? So, this is the actual income statement. So these numbers, the orange numbers, are the numbers we should have had if everything went as planned. If we had harvested 8,000 pounds of oysters, and we did, our revenue should have been $32,000. Our expenses should have been $20,580. We should have made $11,420. That's what we should have done. Here's our actual results. These are our actual results. We really got 8,000 pounds of oysters. So we did what we thought we were going to do. We'd expected to sell those oysters for $32,000. We actually got a little bit more. All of these are real numbers. Our total expense we expected to be $25.80, and we would have expected to make $11,420. So what I did is I took both of those numbers, the actual numbers and the flex numbers, and I put them side by side for you. So the actual results, these were reported on the income statement. They're the actual numbers. These are the planned numbers. If we get 8,000 pounds of oysters, how much will we make? That's these numbers. And now we're going to look at the revenue and spending variance. This is the variance where we look at our actual results and we're going to compare them to the flexed budget numbers. In other words, we've expanded or contracted our budget numbers to what we thought they should be. So, our revenue was $35,200. We'd expected it to be $32,000, so that's an increase of $3,200. $200. That increase is not due to any difference in activity, because the activity was where we expected to be. That's a revenue or spending variance. We either made more or less than we had planned at the number. And again, go back to telling your boss, is he going to be happy with that? I think he or she will. That's favorable. Now I'm going to take a look at my packing supplies. Again, this is not an activity variance because our activity was right on. We expected 8,000. We hit 8,000, spot on, and all of these numbers were adjusted for an output of 8,000 pounds of oysters. We expected to spend 4,000 for packing supplies. We spent 4,200. We spent 200 more. That's unfavorable. Let's take a look at our oyster bed maintenance. I guess it's tough to put those oyster bed sheets on the oyster beds. Anyhow, the oyster bed maintenance, we expected to spend 3,200. We only had to spend 3,100. So we spent $100 less. That's favorable. That's a good thing. Let's take a look at our wages and salaries. We expected to spend $5,300 to harvest 8,000 pounds. We spent $5,640. And remember, those numbers came right off the income statement. Right there, $5,640. So we spent $340 more than we expected. That's unfavorable. Let's take a look at shipping. We expected to spend $6,400 to ship 8,000 pounds of oysters. We spent $6,950 to ship 8,000 pounds of oysters. So that's an unfavorable variance of $550. Again, just go back to the simple rule. If you tell your boss about that number, will he or she be happy? If he or she is happy, it's favorable. If he or she is unhappy, it's unfavorable. For utilities, we expected to spend $830. We spent $810. We spent $20 less. That's favorable. And I love the other category, the other. I hate when clients use the term other or miscellaneous or assorted. But we expected to have $850 in other expenses. We had $980. That's $130 more than we expected. That's unfavorable. So let's take a look at our total expenses. Our total expenses, we expected our total expenses to be $20,580. Our actual expenses were $21,680. That's $1,100 unfavorable. You got to go tell your boss you spent $1,100 more than you expected. But while you're there, say, oh, by the way, boss, despite all of those, we made $2,100 more than we expected. We expected to make $11,420. We made $13,520. That's a $2,100 favorable variance. So, that's the concept. Did you make more money? Yes. Did you make more money than you expected to at that level of output? Yes. That's the value of a flexible budget. So you're looking at revenue and spending variances, not just activity variances. Because if you're looking at just activity variances, if you do more, you're probably going to spend more, you're probably going to make more. If you do less, you're probably going to spend less, probably going to make less. It's not until you flex the budget to that level of output that you come up with numbers like this that say, how much did we expect to make? How much did we actually make and spend? And what's the revenue and spending variances?